when you can start talking about passive income. If you have less than 5 properties, just hope that they're paying for themselves. If you do it right, you are going to make passive income, but you're not going to make any real money in a matter of 12 months.
If you got one unit or like 2 duplexes, like if you have any, like a portfolio under 5 units, you should not have the mindset of, hey, I'm doing this for the passive income and the financial freedom. Like you hear that phrase thrown out a lot, and like, okay, like I made $2,000 in cash flow for, like over my expenses from this rental property, so now I'm gonna go spend that on my lifestyle. Like, don't.
No, that's why they're called long-term rentals. You're not going to make it. You will make if you do it right, you are going to make passive income, but you're not going to make any real money in a matter of 12 months. It's a course of building your portfolio over time, watching that portfolio appreciate over time, and it's a system. And I find that the most successful real estate investors figure out their system and do it over and over and over again before you know it, after 5 years, you have 50 units.
Yeah.
And that's when you can start talking about passive income, paying for aspects of your life. But you hit it right on the head, where if you have less than 5 properties, just hope that they're paying for themselves.
Mm-hmm. Yeah, if they're paying for themselves, that's great. And
that's great.
Anything you're making on top of that, your mindset should be, I'm reinvesting this into the portfolio. You need to be putting together like a rainy day fund,
right?
And working towards getting to scale. Like work on growing your portfolio, on collecting more units, because it's once you get beyond 10 and then beyond 20, that's when you can start to see the effect of, I have this economy of scale. So if I get the call that, AC went out or this roof is toast and we need to replace this roof, you're not like, oh, this ruined my year. That's how you feel if you have less than 5 units. Like you went from, you have this asset you bought that you were hoping would pay you, and now you're paying it.
Right.
Like you're having to put some of your other hard-earned money into keeping this property livable. But that totally changes once you have like 20 units and you're getting $20,000 or $25,000 a month in cash flow. Then it still stinks when you have surprise deferred maintenance, but you've got the cash for it.
And I think that goes back to what I was talking about earlier, and I was referring to more so newer investors, where play it safe when it comes to location, and it all goes hand in hand, where I think these newer investors, where they make their mistakes is hoping that they can try to get as much cash flow as they can. Mm-hmm. And that's where they end up shooting themselves in the foot. And be risky with those gentrifying areas once you have 10 solid investments. Mm-hmm. Don't do that right out the gate, because then it's more detrimental to you when you're buying these older properties with older mechanicals and stuff like that. I think it's important to buy something that's sound, that will pay for itself, and do that over and over again to the point where you can be riskier with your investments. I think that's the good key to it.
Have a diversified portfolio where some of your units are equity plays and then some of them are cash flow plays.
Right.
Yeah, you can certainly take bigger swings once you've kind of got that foundation built. Exactly. Yeah, that's absolutely true. I like that phrase, like a moonshot investment. Like you can do that once you've got kind of a solid foundation of, sort of your stable investments are all there.
Mm-hmm. Yep.
Okay, so this is a good kind of transition into one thing I want to talk about and ask you is, what have your experiences working with real estate investors and rental property owners changed about how you live your own life? I know I'm kind of putting you on the spot, but I mean, certainly feel like this.
Yeah. So pretty straightforward.
It's funny, like the amount of people I meet that work if you work in property management, I don't think I've ever met a property manager that's interested in buying properties in D-class areas.
I would be surprised.
I mean, that's just what it is, because when you operate at any kind of scale, that if somebody owns a D-class property or like a property in a D-class area and hasn't dealt with, an eviction or just a really hairy turnover, they're lucky. Yeah. And it's sort of just a matter of time until they do.
Very true.
It's just the truth.
It hits on a lot of our internal team calls where we talk about 20% of your work or 80% of your workload comes from 20% of your properties. And that's true, and that's something that I think anyone in our position that would be looking to invest in a rental property, you just know what's coming. If you're talking about like a D plus or like a C minus property, you know how often the tenant's going to be putting in work orders, and how the utilities can get hairy, or just dealing with damage to the property, whether it's during a turn or during an eviction or anything like that. You know what's coming.
And I mentioned I mentioned the hairy tenants, or the tricky tenants, but the D class properties also come, like you said, they're just not. There's something that's going to go wrong with these properties. Like and this goes on adding to your question. Like, I'm looking for a mechanically sound investment. I mean, the furnace doesn't have to be brand new, but I've grown to be able to look at a furnace and just know that, okay, that was installed properly originally, and the ductwork looks good, and we could get into a whole line of things. But ultimately, it's like a structurally sound property. I can do the cosmetics afterwards, but what's really going to cost you is the structurally sound properties. And so many times have I walked into a duplex and you can tell that it's 100 years old. Just by looking at the trim, looking at the windows, and it's just, it's been patched over again and again and again.
Like when problems came up, mechanical or structural, they weren't dealt with in the proper way, and so you've just, and you're just dealing with a completely shot foundation, and it's always I get sad when I walk those kinds of properties, because I mean, we have plenty of properties we manage that are, that same 100, 150 years old, but they were maintained right through the years, and they're still standing. And honestly, I would trust those almost more than half of the new builds we're seeing these days. But it all just comes down to, I mean, you're just dealing with, probably dozens of owners over the years, and what was done, what corrections were made when it needed to be made. And you kind of,
You can check out our full library of episodes wherever you get your podcasts.